Welcome everyone. This short tutorial is appropriate to students studying accounting and finance, also professionals in the accounting and finance industry. Now, if you're studying or working in finance, you will come across presentation of financial statements, which is governed by IAS 1. IAS standing for International Accounting Standards. And it is fair that the first standard talks about presentation of financial statements. So what are those statements that are required by IAS 1? Well, number one is the statement of financial position, which shows the assets, equity, and liabilities position at the end of the accounting period. Now, the statement of financial position, as the name implies, is a position. So it's just a snapshot of the company or the group at the end of the financial period. Statement number two is the statement of profit or loss and other comprehensive income. Now, what is the difference between the two? Although they are both in the same statement, the statement of profit or loss shows any profit or loss that has been realized by the company. For instance, if your company is involved in the sale of shoes, then the profit or loss will show what has been realized through maybe buying and selling of shoes. Other comprehensive income states those income which has not been realized by the company. An example is a revaluation of property. Now, if you just revalue the property, well, the value will go up, but you wouldn't have realized this income until you sell the asset. So it is there as other comprehensive income, meaning it's not realized. Statement number three is the statement of changes in equity, and the name speaks for itself. Here it shows the movement in equity. According to IAS 1, you're required to show notes to the accounts and also comparatives, meaning you're required to show on a year-to-year basis the different figures. And this is excellent for analysis purposes. Normally, 2 years is required at the time of reporting the financial statements. According to IAS 1, other or additional information are required by companies when they publish their financial statements. Let's look at those additional information. Number one is the name of the reporting entity. And I've used the example of Nike here, Nike Inc., which is based in the US. This is the name of the reporting entity. According to IAS 1, the company should mention, or the group, whether the accounts represents individual accounts or group accounts. In this case, consolidated means group accounts. IAS 1 also requires the company to show the reporting date. So in our example, May 31st is the end of the accounting period, and we have 2 years, 2020 and 2021. IAS 1 also requires the corporation to show the presentation currency, in this example, the US dollars, and finally, the rounding used in presenting the amount. So here, clearly, it is in millions. So if we're looking at the assets of Nike Inc., if we're looking at the total assets, this is $37,740 million or $37 billion. let's look at the information that has been disclosed by Nike Inc. According to IAS 1 earlier. We saw the consolidated balance sheet or statement of financial position. We now see the statement or the consolidated statement of income. We now have an extract of the consolidated statement of cash flows for Nike Inc. We also have the consolidated statement of shareholders' equity, which shows the changes in equity over the financial period. Finally, we have the notes to the consolidated financial statements of Nike. The notes will form an integral part of Nike's annual report.